Hey guys, Jason at Hard Money Bankers, and I want to go over the importance and fully understanding why you want to be the lender in the hard money lending transaction and not just a broker. We've done some other videos related to raising capital, so we can reference those. But for the purpose of this video, I really want to emphasize the importance of being the lender and not just the broker. If you have some opportunities and you're having a hard time finding the cash for them here and there and you got to broker it out to a lender, that's fine. But there's so many benefits of being the lender. Obviously, you're controlling the transaction. You can make the rules. You can determine what works and what doesn't work. But on this video, we're going to talk about the economics of it. So many people think that the hard money lenders, the private lenders, they're making their money just on the points. And the points are important, obviously. Depending on what market you're in, if you're charging 3 or 4 or 5 points, sometimes even higher than that, that's great. Don't get me wrong. You do a $100,000 loan and you make $3,000, $4,000, $5,000, that's great. But over time, the real money is made on the arbitrage of the servicing money that you're making on the note rate of the loan. So let's say you're lending the money out at 13% and then you give the private investor 9%, you're making that 4% arbitrage. Over time, as your portfolio grows, that gets bigger and bigger and bigger and bigger. Let's say it's a $100,000 loan and it's out for a year, that's $4,000. You're doing 4% on that case. And then you grow and you grow and you grow. We have $35 million outstanding right now. So you can do the math on how that's grown. And that didn't grow overnight, don't get me wrong, but the portfolio grows over time and over time and over time and over time. And a lot of that money comes from that. Keep in mind, as you grow as a hard money lender, you're gonna have costs. You're gonna have marketing costs. You may have some administrative costs. You have some bookkeeping costs. Maybe you have a salesperson. Maybe you have processor and things like that. So the goal is to try to get all those costs wrapped in to the upfront fees. Obviously, you wanna make money on the upfront fees as well. But the purpose of this is to understand that you can't just be a broker out the loans, make your one-time fee, and it's over. You wanna have a trail of income that's coming over. It's coming in on a regular basis. I mean, think about it like this. Let's say we don't write any loans this month. We're still going to get paid because we have an outstanding portfolio. Every time a check comes in from a borrower, we get our servicing fee on that. Now, yes, there's servicing responsibilities as the servicer, as the lender, related to making sure the loan is performing, making sure payments are being made on time, going after defaults, making sure taxes and insurance and all of those things are up to speed. And obviously, those are all things that are super important that have to be done. But those are things that need to be done as a private lender in order to be successful and in order to make money doing it that way. So I hope that makes sense to you, because I know so many people out there that say they're hard money lenders and they broker deals. They have zero control because they're brokering it to somebody else who makes all the rules, who's putting the underwriting stuff in place. But they're just living for their next deal and their next deal and their next deal and next deal. I don't know about you, but I don't like to just have to wake up and be reliant on closing another deal and close another deal. And hey, I make my $3,000 or $4,000 here. Hey, I make another $3,000 or $4,000 here. I make another $3,000 or $4,000 here. That's great. Don't get me wrong. That money's very important. And growing your portfolio and doing more and more deals is important. But the main part and the main income from the lending is the servicing and making that arbitrage. And it's up to you about how you do that. If you want, you can give a private investor a bigger return or a smaller return. My only recommendation on that is when you are raising capital and you're dealing with investors that have money, typically sophisticated investors that have money, typically they're smart and they want to get a decent rate of return. So good rate of return for an investor in the hard money space, as a private investor in the hard money space, is anywhere between, I would say, 7% on the low end and maybe 12% on the high end. We usually come in around 9 or 10%. That's what meets our investors' specifications. If there's any one downfall of this business model, is the income from it is interest income. So it gets taxed as ordinary income, short-term capital gain income, right? So it's taxed at a high tax bracket. So any private investor of ours who, and most of them have a good bit of money, they probably are at like a 50% tax rate. So they don't typically want a 6% return because there's some risk in these things, and then their net return, obviously after taxes, is 3%. So that's why the 9 or 10% makes a little bit more sense for them. Hopefully you found this helpful. I'm glad you guys are following Chris and myself at Hard Money Bankers and Hard Money Business. We've been doing this business for a long time and we're really, really passionate about it, and I'm sure you can probably see that. Any questions that you have related to this particular topic or anything else, feel free to reach out. See you soon.